All right. Today is Tuesday, August 6th. Recording is on. So today, what I want to do is go over the Costco homework assignment that you did. And then essentially, we'll start talking about the final content for the class, which will be on multiples. So we'll go through some examples in class and preview your next week's homework assignment. Okay. So with that in mind, actually, before I jump in, questions about anything?
Do you think there's any valid concerns of a recession happening? The market's been swinging up and down with no real, I say, answer from the market.
It's a good question. I think that, well, honest answer is it's an election year. And usually we don't run into recessions in election years. Like Fed's probably not going to do anything too crazy. That being said, interest rates have been very high, and if they remain high, I mean, I think I agree with a couple of columnists that they were slow to raise them when inflation was kind of taken off, and I think they've been slow to lower them as the economy has been cooling. And so I think that's going to be the short-term challenge. The market volatility is somewhat related to the uncertainty, but I did a LinkedIn post earlier this week, but basically you can kind of see what happened in progression. They didn't lower rates last week. The jobs data came out, which was disappointingly lower than expected. Amazon came out with earnings that on the call, they lowered guidance and particularly talked about softening consumer demand. And even though their AWS business is still booming. And then essentially we saw Warren Buffett start to bail out of Apple. And I think that put a little bit of a damper on some of this AI and tech boom that we've been seeing recently. So, is it going to be as good as it was? Maybe not, but will we be in a full-fledged recession? Don't know. That's my honest opinion. Take it where it's worth. If anybody else wants to chime in.
Thank you.
Anybody else have any additional thoughts on that?
I saw JP Morgan made a ton of moves while retail investors divested a bunch of stuff.
You mean they started buying?
Yeah, when that VTX or VXI or VIX picked up, mostly it was retail traders and the big investment banks bought all the assets. So they bought the dip.
Sure. And is everybody familiar with the VIX index in general?
I am not.
Let's see if I can.
Someone yesterday bought like $650,000 worth of VIX calls that expire, I think, in November, which I thought was pretty.
So, there is the share button. Zoom keeps updating their versions and changing their menu to confuse me. Share Bloomberg. So this is 5 years of the VIX. It's basically Chicago board created this index of volatility, and the general idea, and you can think of it in terms of the cost of capital as well, is that what we talked about is when there's more volatility, there's more risk. When there's more risk, then essentially prices tend to go down because there's more uncertainty, and therefore people expect higher rates of return for that uncertainty. Cash flows don't change, prices go down, and so basically you see the market tend to struggle in times of uncertainty, and the VIX is essentially what we're using as one metric of volatility / uncertainty. And so you can see that in 2019, 2020, it was really, really high. That was leading into COVID. And then it kind of calmed down. Markets have been kind of pretty stable ever since we kind of emerged through COVID. And then recently it's spiked up. And that's just, people are looking at this as just saying, look, there's a lot more uncertainty, therefore a lot more volatility. And it's just a proxy for a market sentiment. Don't know if they go back to 2007. Remember when they created this, but you can see that, for example, this was the real estate crisis. And when we were having all that, the real estate volatility, and therefore the Wall Street banks were starting to go under, Lehman was going under, that's when the VIX kind of got publicly famous. And that was the gigantic spike in volatility. So this was that meltdown. This was COVID. So not nearly as bad, but nonetheless, as a short-term spike versus the relative calm in the markets we've seen in the last 6 to 12 months. All right, so let's talk Costco because one of the things is Costco, if we do head towards some tougher economic times, they are a company that probably with a lower beta would be a stock of more safety, relative safety than some other companies. Not that we did the EIC on Costco, but for this part of the analysis, but we did a evaluation, as is Bull Bear and Target. So let me go ahead and share my Costco as is, because we should have data very similar to that. All right, share. All right, so you would have taken the Costco data I gave you. You would have basically copy paste special valued into the first model tab. I built my Costco model off of the Walmart model that we had previously done. That updated Costco. We see that we then start updating the data for Costco, knowing that fiscal 23 was their last reported year. So assumptions, make sure that last reported year switches to 2023. We had a screenshot for the WAC, which was 9.4% as of the time of the screenshot. We had a DES screenshot where we could check out the shares outstanding, which was 443.3 million. At the time of the screenshot, it was $810.45. So that's the price we were trying to match for the as-is valuation. From the EEO and EEO2 screens, these would be the consensus revenue and EBITDAs for Costco. And from the EEO screen, these are the forward year 2 and forward year 3 EV to revenue and EV to EBITs to estimate our perpetuity EBIT margin. Over in the ratios, very important to remember that if you're using another company, in this case I was using Walmart, some of Walmart's data was still in there. Now we never really changed any of the balance sheet ratios, and Costco's productivity seems pretty consistent over time, so didn't see a need to change that. From the guidance screenshot, 26% seemed to be their forward tax rate guidance for the future. So I put that in there for the as is. And then based on here, perpetuity margin 3.7 to 3.9, put in EBITDA of 4.8% to get to 3.9. Okay. And then thought about lowering the out year 2029 revenue growth rate. But when I goal seeked and saw a G closer to 8%, I decided to leave that alone in that 1 year, but basically came out with a G at about 7.89%. And my guess is that we should all have data somewhat similar to this. If you changed your EBITDA slightly, your G might be a little bit off, but it should be in the high, 7, 8 to 8 range for a G. So I'll just pause to see if we all got kind of similar data for Costco or had any questions about that. Anybody get anything radically different? Yeah, Raymond?
Yeah, I was curious about the G, the perpetuity G and the revenue growth rate. Can you talk about the relationship between those two, or which is more impactful?
Well, let's start with an assumption that we referred to, I believe, early in the semester, that people make in finance. Let's be explicit about it. If your margins are constant, then growth in revenue and growth in profit are the same. Okay. And so therefore, we will often use growth in revenue and growth in profit almost interchangeably. But when we're doing that, we're assuming a constant margin. And so when we say G here, this is actually growth in cash flow. Now, here's the next thing. Assuming productivity, which is this number, kind of stays constant, then growth in profits equals growth in free cash flow. Okay. So basically, if your margins stay the same, and if your levels of reinvestment stay the same, then growth in sales, growth in profits, growth in cash flows are pretty much related. Right. So technically, when we're talking about G, we're talking about growth in cash flow / growth in profits. But we can proxy it out for growth in revenue because we're assuming that this company is probably going to have pretty constant margins. And you can see that even in the historical, like Costco's margins are almost like a clock. They're very consistent every year. And that is actually part of their deliberate strategy to grow the business.
Okay, thank you.
Does that make sense?
Yes.
Okay. Great question, though. And if anybody else has them, feel free to keep them coming. But back to this while we're waiting on that. Again, did everybody get numbers similar to this and a G similar to this? Any questions on where any of this data came from? I didn't pop up the screenshots, just kind of showing you the result of what I typed in, but happy to show you where it came from a screenshot if you had any questions about that.
I actually did have a question, and it was kind of, we were talking about it a little bit in the chat. But I had in my notes that we were supposed to use the price point that was in the DS screen that was like below the chart, but that number didn't match what was in the prompt for the homework. It was off by a little bit. Like, I guess I just want to double check to know where in terms of price, current share price, where should we grab that from that screenshot?
Let's do two things. So let's go back to assignment. Where was it? Screenshot. All right. So for 8/10/45, it was that number right there from the screenshot. So when you say the number below, which number are you referring?
I guess I thought it was the PX change 10, like where it says 810.32 underneath the price chart on the left side, like the third column, like you go further down.
On this chart you're talking about?
No, like go down a little bit more underneath the price, right? It's on the first screenshot, but it's under the graph.
Or screenshot under the graph.
It's the very first screenshot up at the top. Underneath that little blue price chart graph.
Oh, price change in 1 day.
Yeah, I guess I thought the 810.32 is where we're normally grabbing the price amount, but I guess that's not correct. It's really the upper left-hand corner.
Yeah. Well, yes. The short version is yes. It's the upper right-hand corner. But technically, I had actually given you a price to go to in the assignment. It's the 81045.
Yeah.
Because we should have followed.
Yeah, no,
That's, but just back to this question.
that's fine. I just wanted to know, like, in
So what's happening
Future
in the
ones.
screenshots, and again, I can go back to Bloomberg to show you directly. When I do a screenshot, what I'm doing is I'm basically going to the company and then I'm doing a DES. And then now the market's closed. Okay. But literally when I go to a screen, this is changing in real time when the market's open. Okay. So now that the market's closed, price isn't going to change. Right. But so basically that's going to be the price change, or it's going to be at the time of the screenshot. Matter of fact, if I'm doing these screenshots during the day, like say 2 o'clock, then by the time I get to the WAC screen, the price here, the WAC could be a little different. And that's why it's just convention. I said, let's use the DES one. Because if they are different, like it shouldn't be that much different, but regardless, could be confusing. But that's actually the price of the company right there. Okay. For this value, the price change in the 1 day, I'm not sure that is the last price and a 1 day change percent. So basically it was up, 1.88% today. I don't know why that would be that much different than the top one, but regardless, please use the top one, go forward.
Thank you.
Sure. In fact, I probably should look at the chat, see if I'm missing anything. Okay. Just covering what we're talking about there. All right, so back to the Costco as is. Everybody hopefully got similar numbers then. And even if you use the slight difference in a couple cents of the price, you still should have gotten a G approximately 7.9%. Okay, in the as is. Okay. Now I will say, before we get to the bull, the bear, and the target, and I'm going to actually ask some people to share theirs, right? And your scenarios, kind of like we did the end of class last week. But that 8% into perpetuity for a company of Costco's size should probably have set a little bit of an alarm bell off to say that that's pretty aggressive. Because when you get to be, a couple $100 billion, then, growing 8% a year on a compound basis starts to get to some really big numbers. And I'm not saying that Costco hasn't had a good run of success, but law of large numbers eventually runs everybody down. Okay. And the bigger the numbers get, the harder those percentages get, because especially when we're talking about exponential growth over time. So 8% into perpetuity is aggressive. Okay. And I'm not saying that Costco isn't having a great run, but that's just something to keep in mind when we're doing our bull bear and our target. Okay. All right. So how about one of the individuals or pairs? Why don't you talk about your Costco bull bear? Where did you go? And what were you talking about when you did the bull and the bear for target, or sorry, for Costco? Somebody kind of run us through what you did and why you did it.
I'll do it.
Thank you, Ahmad.
Let's make sure.
You should have sharing rights, so that way we can kind of follow along with you.
Cool. Let's grab it. Wait.
Do you have your file?
Yeah, that's what I was grabbing. Because it was on my screen and then it went to another screen. So that's why I was like, oh no.
Hey, I feel you. That happens to me all the time. All right, starting to come through.
Okay, let me know if it.
Yes,
You see it? Okay.
can see your Excel file.
So then it should be. Let me go back from it. There. Oh, that's my target. Oh, there we go. All right. So ratio.
Is this your bull? Is this your bear? Which file is this?
This one is bull.
All right, so talk us through what'd you change and why?
Okay. So we change as soon as I can show it. It's not.
Why don't you go to ratios? That's usually a good place to start.
Okay. Let's reload.
You may want to just show the write-up because I think we put in the tables. Just show what we changed.
Got you.
I guess it's having trouble loading from SharePoint.
Yeah. I don't know.
All right, well, while Ahmad is trying to find his file, can somebody else go?
I'll jump in on the bull real quick.
All right, why don't you do bull and a bear?
All right, let me figure out how to share this real quick.
So Ahmad, we're coming back to you. So
Okay.
get your files ready. But we're gonna let Chris try and go first.
Okay.
How do I do have sharing capabilities right now?
You should, along the bottom menu, the share button should be active
Okay.
in the Zoom menu. There it is. All right.
All right.
and-
So we only made 2 changes on the bull.
okay.
The first one we did was the EBITDA. We increased that by 0.2%. Due to the new online presence that they're trying to go after. We thought it would create some economies of scale that they haven't yet experienced with their traditional brick and mortar stores.
Okay.
And then in the same vein, on the bull stock price, we dropped the tax rate slightly, depending on what happens here in the election.
Okay.
We dropped that. The average on the previous 5 years was 24.2%. We dropped it by 3% moving forward.
Okay. One minor suggestion is that if it's going to be a post-election thing, it would probably be in 25 as the earliest to see the impact of the taxes as opposed to this. But
Yeah.
Nitpicking that, but go ahead.
And then back to your point on the revenue growth in perpetuity, we tweaked this here and there, and it didn't make a huge difference on the stock price. And I had a question for you as to why.
M3 is just the 1 year. It's just 2029.
Okay.
So what matters, just to be clear for everybody's benefit, that growth rate in M3 only changes the 2029 growth rate. Whereas the operating income margin and the EBITDA margin in M7 and F9, those continue into perpetuity. So those essentially become perpetuity EBITDA and EBIT margins that have more impact, the way the model is set up.
Okay.
And so for the long-term growth, 2030, 31, ... that's in the assumptions tab. That's going to be driven not by M3 ratios. It's going to be driven by assumptions B7. That's going to be the long-term growth.
Okay.
Did you change that in the bull?
Not in this bull.
Okay. So in this bull, if I could just repeat back what I think I heard, you're suggesting the economy of scale in the bull scenario leads to lower margins. You're not suggesting that this omni-channel presence is actually going to drive revenue at a higher rate.
we thought the revenue would stay consistent, but be a little bit more profitable on the
Okay.
operating side.
So that's the point. It's driving the bull scenario for you is driving profit, not driving growth.
Correct.
You don't see a lot of upside in growth.
Correct.
Okay. So what about your bear?
Let me pull that one up.
And by the way, notice that those slight changes did drive the share price up about $90
Yeah, there's a 12% increase on the share price there.
on the bull side.
Yep. And then bear, we said we reduced the EBITDA slightly due to membership loss and more competition. And then we increased the tax rate there, given the November election. We should have left off 2024 from what you just said. We kept revenue growth pretty consistent. And that was a 12.5% reduction in share price.
Okay. And again, I assume you didn't really change the G in the assumptions either.
Correct. We left that where it was.
Okay. So I think I understand what you did. My only just generic question would be, I'm surprised your team didn't think about why Costco could see a revenue slowdown in any case. Like you didn't feel there's anything that could have driven lower sales or driven higher sales.
We did not explore that.
Yeah.
We just stuck to those two.
Well, and I'm just saying, not saying that you could make the argument that you did, but I think that would probably be a minority opinion because typically, like I said, if you really think about it, if we're thinking about the drivers here, could revenue change, which means could volume change, could price change, could mix change. And in a scenario, that's something that could happen to any company. It's just a question of magnitude. And the same thing, can margin change, which you did. Then obviously, yes, another driver, the tax rate changing. But if you think of those as the kind of the high level drivers, could revenue change, could margin change, could level of reinvestment change, could tax rate change. Those are kind of we're keeping it simple at this point, things that could change for a company. So as you start thinking about scenarios, not changing revenue sounds conservative. If you are trying to do a bull and a bear.
Okay.
Okay. Where did you end up with your target?
We weren't far off from, let me pull that one up. You might say it's a cop out. We kept the tax rate similar to the last 5 years. We increased the operating profit or the EBITDA line there slightly, and we determined as a hold for Costco.
Well, I mean, saying that the market you think has it right and they're appropriately valued is not necessarily a cop out, so long as you're giving a rationale for why you believe that.
Yep.
Okay, great. Thanks for going first. And so let's go back to Ahmad. And do you have your files ready?
I do.
Okay, so let's see how your scenario potentially differs and what you changed.
All right, so I'm just gonna go to the analysis because we kind of have the charts already on there. In a bull scenario, we kind of said that they were going to keep being aggressive. So their year over year, their growth was going to be at 8% still. Revenue growth being at 7%. So growth 8%, revenue growth 7%. Their operating margin going down to 3.9. So that was like roughly the same kind of like flat. And then obviously the tax rate being about 22%. Now saying what you were saying as far as taxes having the effect, would probably affect it a little bit less. But the idea is that because their strategy of having like a growth expansion model, they intended to essentially grow more companies or grow more stores, like 31 to be exact, in the next year and some change. So we kind of felt like that inflation of revenue because of the store expansion will kind of make their numbers go up or their revenue go up. And because of that, there'd be more aggressive seeing those numbers and kind of going up. So our bottom number as far as stock price at that time was about like 924 for the bull.
Okay.
For the bear, we had the opposite. So we kind of cut everything down, but just by like a little bit, kind of gave like a little bit of a haircut. So growth went down from 7.9 to about 7.5. Revenue growth went down to 6.5. They still kept a low operation margin, but obviously that got depleted by their tax rate going up a little bit because of economic terms. The reason for the bear, or the bear being what it is, exposure to other stores. So it could be one growing too fast, could be a problem. Also trying to expand in a market where consumer fluctuation in the prospectus. Costco, well, they talked about how Costco is trying to keep the inflation of certain goods like eggs, meat, and other things, just to kind of make sure that they keep the costs down for customers. So they try and keep the loyalty. They know loyalty is there, but they're trying to make sure they have that balance. So for us, price wise for a bear, we said it was going to go down at least to 623 at the lowest. It's kind of like price down. And that's about it. Target wise, we were about the same. We were like in the middle. So we said it was going to pull back and be at like 738 as far as the price is concerned. We felt like they would have the growth that they're saying that they would have, but the exposure and the expansion would take a effect to what they have going on if they keep aggressively trying to expand stores. So
Okay, so you're in the hold range,
yeah,
but you do think that there's a little bit more downside to Costco versus the current price.
correct.
So the first presentation we saw a little bit of upside. You're saying a little bit of downside, both in the hold range.
Mm-hmm.
Okay.
Sure.
All right. So just fast forward. So in a couple weeks, you guys are going to be making your final presentations. And I would say that the second presentation I found to be a little bit more helpful because I like the additional detail on the why, the reference to the stores and the other things that they were trying to do with their expansion. And you're saying, if successful, then this is why the bull, if not successful, why the bear. What was interesting, and I don't know if anybody else mentioned it in your write-ups, is one of the other big drivers of Costco is membership and the membership fees. That's a big driver of their profitability and a big driver of their kind of financial model. And so if this were the final presentation, given that you've had weeks to work on this and a pretty big team, like for the companies that you're talking about, this is a little vanilla in terms of the presentation. And again, training wheels are on, first time doing the project, everybody's kind of going through the process. But I think it's helpful to do a little digging. That's why I say it's often helpful to do an EIC before you do your final analysis on this, just to give you a sense of what's going on with the company, the industry. But
Gotcha.
you do some homework on the companies that you guys are going to be presenting in a couple of weeks so that you can more specifically link things that are going on with the company and the industry to the changes that you're making. But in terms of process, I think both of you did a good job of kind of going through the process. And that was really, for me, the most important thing for this assignment.
Cool.
All right. Does anybody else want to add to that, or questions, comments? Anybody have any other challenges with the assignment you wanted to ask about? All right, well then if not, as I said, you now should have all of the data to model out each of your chosen companies. So as teams, I would start putting the data in and kind of start down this process so you're not waiting to the last minute, so that if you do have any challenges with any of your valuations, we should be able to discuss them preferably next week. I'd rather discuss them next week than wait till 2 weeks when you're trying to do the presentation. And I can already see, after I got the data and put it up there, that there's a couple teams that are probably going to have a little trouble with these valuations. And I'm talking to the Ford team as one example. Yes.
I got a question. So as far as like our presentations,
Mhm.
would it be safe to say that kind of have a little bit of everything we've done so far? Is like your EIC analysis kind of show, like as far as like telling the story of the company that you're kind of picking, would it be a good way or a good processing way to kind of show from EIC to what we have as far as bare bull target and as is to whatever else we're trying to get as far as our analyst pitch?
Yep. I think you said it well. So the presentation is 20 minutes for the final presentation in 2 weeks. Each of the teams. Again, there's 4 sections. Again, approximately 5 minutes per section. If you're trying to get all 4 of them in, but you got to do an EIC, you got to do the historical, you got to do the valuation, and then you'll have to do the multiples, which we're going to start getting into later tonight. But those are the 4 parts of the presentation. And I think what you're saying, Ahmad, is actually helpful. I mean, I'd go through in that order, like lay it out kind of as we've been building it through the semester, because it kind of helps tell the story. Because the EIC sets the ground stage for what's going on in the industry of the company, right? And then the historical gives you your baseline that you're going to build off of. And then basically the valuation is now, okay, based on that, here's the future with the 3 scenarios and where we think they're going to end up. And then the multiples, which we'll talk about tonight, triangulate all of that. So that's kind of how things should build in your presentations. So please kind of follow that format as well. But that's in the assignment, that's the way it's actually written out. And then the other key thing when you're doing your presentation, which I'll continue to remind you of, use numbers. All right. And so both of you did, which was helpful, but continue to use numbers, particularly when you're doing PowerPoint, because it's easy to kind of gloss over things and get really, really vague in general when you're going through the materials. So it's just helpful to understand what you're talking about. Yeah, Raymond?
In terms of realistic numbers and values, are there anything that we should look out for? Like you mentioned earlier in the class that like an 8% growth rate for a mature company is probably might be difficult to achieve. So that kind of lets us know to be careful about going beyond that number. Are there any other numbers or values that maybe we should be careful about going too far away from?
Well, if you're talking about mature companies, and I think both the book references this, and I think we've talked about it previously. We talked about EIC, but I'll mention a couple. So number one, over time, you tend to see regression to the mean. Okay. And ROIC doesn't stay extremely high forever. Think NVIDIA. It's never going to stay at 90% for the next 10 years. Like that, no one's ever done that. So I wouldn't expect them to do that. And if you can see what continues to happen to poor Intel, like Intel's is the point. Like Intel looked like NVIDIA 20 years ago. And today, Intel is a basket case of a company that's laying off 15% of their workers and basically admitting that nobody wants their chips anymore. And that's a real challenge for Intel, because the world is going to go. And back to McKinsey's point of view, like that's what their research says. Nobody maintains their competitive advantage forever. So when you have high rates of return, just when you think perpetuity, I'm not saying it can't be done, but it's really hard to do. So they tend to regress to the mean. Same thing with growth rates. Growth rates tend to regress to the mean as well as you get larger. And one of the reasons, which I referenced a few minutes ago, is the law of large number effect. And so when you start to be mature, generally, certain companies tend to grow with their industry. Well, industry right now for retail is going with the economy. It's close to 2-3%. And if Costco is going to grow at 8%, that means they're growing 2.5 times as fast as the economy into perpetuity. And I'm not saying they can't do that, but it just gets to be unlikely. And I think Costco's growth rate over time is going to start to go down. So that would just be my bias on Costco, meaning, if unless they go international and really, get a whole lot of growth outside the US and North America, which they're currently not doing, then that growth rate is going to struggle to maintain 8%, right? Because basically what you're saying is, I'm going to keep taking share from everybody else. More and more people are going to keep going to those Costco's. And Walmart isn't going to challenge them, and online is not going to challenge them, and they're just going to keep outperforming. And when you get to like 2, 3, 400 billion, those growth rates get harder. Now, I'm not saying that some companies aren't doing that. Amazon has been growing at a pretty hefty rate. But remember, Amazon is not just in one market. Amazon's doing other things. They got web services, they got video, they now an ad agency. They're trying to get into healthcare. So they're growing on multiple vectors. Costco's not. And so, unless you're talking about something changing, just my initial alarm bells are going off when I see an 8% G for that big a company in a more mature business, that's aggressive. Okay. Now, not saying that the market's not valuing them that way. They clearly are. But, this is the same thing in a microcosm that I think we're seeing, which I referred to, last week with Tesla. Some of these early stage companies that are the early stage darlings, we just assume that growth story with Tesla is going to be forever. It wasn't. We're going to assume that NVIDIA, that growth story is going to be that way forever. It isn't. And not that Costco's growth story isn't going to maintain, but will it maintain this well for the next 20 years? It's a question. And I think it's just saying that they'd have to be an exception to go against some of the other data that we've been seeing. So those are just some things that I would say. That's why, for example, I said, reset your G's to 3% when we start doing these other companies, because one of the things we'll look at tonight is consumer products companies. I don't think Procter & Gamble is going to grow at 10% a year. So we've got to just kind of look at what is a reasonable rate of return, and then reasonable growth rate, and then ROICs. Most companies, there's a reason you're in a cost of capital. Most companies tend to go to their cost of capitals over time. Average ROIC in the S&P 500 is probably around 10%. So, outperforming that for long periods of time, not easy. Can people do it for short periods of time? Absolutely. But, very few companies do it. The book didn't have this, but there was a study I saw once where they just broke the S&P 500 into quartiles. And the question was, if you were in the top quartile 5 years later, how many companies were in the top quartile for ROIC performance? Statistically, best companies, 25% for ROIC today. Over time, how many stayed in the top quartile of ROIC 5 years later? Does anybody know the approximate number? So how many of your top performing companies stayed top performing?
1.
20%.
Yeah, it was around 25%. So it's a good guess. Right. So that's the whole point. 75% of the top performing companies are unlikely to be in that quartile 5 years from now. Ironically, if you take the bottom 25% of ROIC companies, same thing happens. About 25% of them stay bottom performers for 5 more years. You know what happens to the other 75% of the companies that are in the bottom quartile today? Ironically, they start to move up. Some of them die, but a lot of them actually improve. They don't usually go from bottom to the top. They kind of go from bottom to less bottom or the middle. But what ends up happening is that these companies tend to get starved of capital, and they adapt, because you have to. It's either adapt or die. So you're going to go away, or you're going to find a way to adapt, and that forces you to try and improve. So it's actually hard to maintain low performance for very, very long periods of time consistently. So people either move up or down. It's the regression of the mean. There's just a big magnet in the mean historically, right? So that's just something else to kind of keep in mind as we're doing these types of analysis. But industry situations can be somewhat unique. That's why we do EICs.
Okay, thank you.
Sure. Great question. Anything else on this assignment, or to some degree what you're going to be doing for 2 weeks from now with this type of assignment? You have your raw data. Sometime this week, I'm going to add some analyst reports and some other stuff, but feel free to supplement. Like you can go on IBIS World, grab an industry report. Technically, you can use other stuff, movers, whatever that you have access to, as long as you put the context of that in the way we're talking about in this class. Right? And so I'm not saying you can't use other data, but for example, I don't want to see a lot of stuff in 2 weeks talking about return on equity as opposed to ROIC, right? Because that's not this class, right? So anything you use, put in the context the way we're analyzing companies and industries for the frameworks that we're using. All right, let's move on to the fourth section of the content, and let's start talking about multiples. So that's going to be lecture note 4, which is posted in the files lecture note folder on ELMS. Grab lecture note. This file. You all right. So lecture 4 gets us into the fourth section, which is going to be talking about either comparables or comparables, depending on how you want to do that. But it's basically a multiple analysis based approach. And the idea of a multiple analysis is that when we do a DCF, we basically say, if we can figure out what the cash flows of the companies are going to be, we should figure out what the price should be. Okay, kind of working forward. With multiples, you kind of work backwards. And with multiples, you say, okay, I know the price. All right, so what can understanding the price of the company tell me about its valuation? And it's a relative analysis, right? And so a good example of this in the real world is if you ever buy a house, okay? Because there's going to be an appraisal on that house. And the way that the appraisal is going to be done, it's a multiple analysis. What the appraiser is going to do is they're going to look for, in the last 6 months, similar type houses, and then look at the selling prices of all those houses. They're going to look at the square foot of every one of those houses that sold, and they're going to take the price divided by the square foot to get price per square foot, a multiple. And they're going to get an average for your area. So let's say your price to square foot multiple is, I'm just going to make up a number, $200. Okay. So if the average house is selling for $200 a square foot, then I want to appraise my house. Then what I say is, okay, my house has 2,000 square feet times 200 per square foot. It's worth $400,000. Right. And that's the starting point of the appraisal. And then what they're going to do is they're going to say, okay, well, the average was 200. Do you have kind of the same features as the average? Well, then they're going to look at things like lot size. They're going to look at location. They're going to look at the age of the house, the conditions of the house. They're looking, for example, number of bedrooms. So for that 200 per square foot, if that's all 3-bedroom houses, you have a 4-bedroom house, well, you might get a little bit of a bump up. They're going to look at school districts. They're going to look at taxes, some other features. So they'll adjust up and down, but they're still going to use the relative values as a benchmark. Okay. Now, there's something called the law of one price that says multiples are just another way of valuing the same asset as the cash flows. And you can't get different answers. Like you technically got to get the same answer, right? And you can't, just because you change your methodology doesn't change the value of the company, right? So you're still going to get the same DCF. But the way I like to say this is that if you think of ROIC as a shortcut for free cash flow, multiples are the shortcut for free cash flow valuation. They're simple. Okay. If I take a multiple, price to earnings multiple, and I have $5 of EPS and my price to earnings is 10, and the share price is 50. And if I have $6 of EPS and the multiple is 10, then the share price would be 60. Right. So it's just a way of simplifying the DCF. Right. So the advantage to multiples is that they're simple and they're easy. The disadvantage to multiples is that they're simple and they're easy. They're overly simplistic because we're literally taking the entire value of the firm and basically pushing it down to one number, right? And so therefore, it's a broadsword. It's not a scalpel when we do valuations, right? But one of the reasons why bankers love them in the real world is because of lawyers. So let's say that you're advising a company on going public or doing an M&A or whatever they should pay. Well, when you get sued, all right, and you're on the witness stand and somebody asks you, opposing counsel, how'd you come up with the value of the company? You say, well, here's my DCF, right? You're going to get crucified in every one of those single assumptions. If you say, how'd you value that company? And say, well, I actually looked at all these other companies that were publicly traded and I valued them based on actual data in the real world of market prices, then it's more defensible. Okay. So I think that's another reason why people like multiples, because DCFs are kind of like a theoretical value. Multiples are based on real world actual prices, right? It's kind of a relative valuation. So multiples look at market prices as a benchmark for valuation. They can actually be helpful to value private companies as well as public companies, because they can say, okay, if a public company that looks like this is trading at this value, then a private company that looks like this should probably be trading at a similar value. Okay. And one of the challenges with multiples, which we'll get into, is finding what is actually similar. It sounds simple, but it's actually not as easy as you think it is. Okay. And obviously, current prices play a role and sensitivities. So back to the challenge. One of the biggest challenges of multiples is finding similar companies, right? And I'll give you a simple example. Let's say I'm trying to find a comparable to CVS. Rite Aid? Everybody agree Rite Aid would be a good comparable to CVS?
Yeah, that's what I just said.
Okay. But here's the thing. If you think about CVS, their stores are about a third of their business. Another third of their business is Aetna, the insurance company. Thank you. And another third of their business is essentially CVS was a Caremark, which is the drug distribution company. So they have 3 businesses, right? So when you look at CVS against a competitor like a Rite Aid that doesn't really have an insurance company, or Walgreens that doesn't have an insurance company, you're kind of comparing a little bit of an apple and an orange, right? Same thing. You're going to compare Aetna against Humana and maybe United Health Group, right? But United Health Group doesn't own a bunch of stores. Humana doesn't own a bunch of stores. So that's what I'm saying. Like when we do these comparables, they're not as easy as you think because companies actually do different things. So for example, a couple of weeks ago, I was at a company called RTX, which was a merger between essentially a commercial company, United Technologies, which made aircraft engines and built parts for commercial airlines, and a defense business, okay, which makes like the HIMARS or the Patriot missile system, anti-missile defense. So defense companies, RTX measured against Lockheed Martin, Northrop Grumman, blah, blah, blah. But another half of RTX's business has nothing to do with Lockheed Martin because they're actually being compared to all of the commercial companies. And so, for example, Rolls-Royce jet engines as one example. So finding comparables can be a challenge. There's very few companies that actually do just one thing, and their competitors just do one thing. Okay, like even if you think about cruise ships, you got Royal Caribbean against Carnival. That's actually a pretty good direct comparison, right? But Disney owns a cruise line. It's a pretty big cruise line. And when you compare Royal Caribbean against Disney, well, Disney's got theme parks, Disney's got a movie studio, Disney's got Disney Plus. They got a lot of stuff over there that has nothing to do with the cruise lines. So yet Disney is a competitor and peer of Royal Caribbean. So again, this just gets back to the challenge with multiples, is that what you end up having to do is that instead of just looking at purely the company, you want to try to look at companies of similar sizes and kind of similar growth rates and similar returns. That makes them more comparable, right? And just as another example, you don't want to compare a company like Meta with a social media startup, right? Because even though they might be doing social media, it's really a different business. They're going to have different growths, different levels of return. So ideally, you want to have companies with similar growth rates and similar levels of return when you're doing your true analysis, right? Again, not always easy to do, but that's actually the challenge with multiples. So the process for a multiple analysis is pretty straightforward, right? First, find the companies, find the peers, preferably ones that have similar profiles. Two, once you've identified your peer group, then get your data. Your data is going to come from Bloomberg. Three, calculate all the data, calculate your market multiples based on the market current data. Again, that's going to come from Bloomberg. Then you kind of benchmark and try to understand the differences between the companies and then explain it. Best practices. Already highlighted it. One, try to choose companies with similar prospects for ROIC and growth. Two, we've already started this. Forward multiples, not historical multiples. The book makes a big point of this, right? And the idea is that a company is worth the sum of its future cash flows. And so therefore, the forward multiples and the forward earnings that they're based on are more indicative of the future cash flows than the historical cash flows. So even though in the real world, a lot of people will use last year's PE, 12-month trailing PE, the professionals tend to look more at the forward multiples, okay? Because they give a better relation to the future cash flows. And that's why we started with the valuation. We're not using forward year one, okay? We started with forward year two, forward year three, because when you're doing multiple analysis, it's better to have 12 months of clean forecast. The multiples tend to get more normalized, right? I like to think of the current year, forward year one, as a dirty year. When you mix actual data and forecast data, you don't get as normalized a multiple. So again, McKinsey has shown that over time, you get better multiples when you do multiples based on clean forecast years. That's why we started with the second and third year out in Bloomberg, and we didn't use the first year, the current year's multiple, even though it was a semi-forward multiple for our valuations. We also tend to prefer enterprise value multiples, right? And the reason why is enterprise value multiples tend to be more explainable than price to earnings multiples. Even though PE is probably the most ubiquitous multiple out there, and everybody's at least heard of it, it's actually the hardest multiple to explain because price to earnings multiple is based on earnings per share, which means it's based on net income, okay? And so therefore, when you're explaining what's driving a PE ratio, you got to explain everything that goes in net income, which means it's not just the operating costs and the non-operating costs. You got to explain debt, capital structure, taxes, non-operating gains and losses, all affect PE, okay? And so, for example, the amount of interest has a big impact on PE, right? So you have two companies, they're identical. One has debt, the other doesn't have debt. Because the one has debt, it's going to have lower earnings. It's going to affect their multiple, right? Even if the values of the operations don't change. So we tend to prefer enterprise value multiples because they tend to mitigate some of the problems with capital structure and the one-time gains and losses. Think of it another way. If you stop at EBIT then enterprise value to EBIT, you got to explain to EBIT. All right. You don't have to explain everything below EBIT. All right. Stop at EBITDA, EV to EBITDA. You don't explain usually everything below EBITDA, and it tends to be more normalized. When you got to go all the way down to net income, you got to deal with everything net income. And then for the kicker with net income, you got to deal with all the GAAP accounting weird stuff that's going on. So accounting can distort this. It can distort net income, and that could distort a PE. Enterprise value multiples, EBIT, EBITDA, less distorted by changes in the accounting rules. And so therefore, enterprise value multiples tend to be more preferred. Not saying we don't use PEs, but as simple as it is, actually is a pretty complicated multiple, and it could be the most distortable multiple. And then finally, and it gets back to adjustments. If you have two companies and they're identical in every way, and one company's got a ton of excess cash and the other does not, well, that's going to distort the multiple. So non-operating items can distort multiples, and we got to be aware of that. Okay. Now, we're not going to get too advanced in this class. We don't have time, but I at least want you to be aware of that when you're doing your multiple analysis. If you have questions about this, feel free to jump in. All right. There's also something called precedent transactions. All right. That's M&A. And I'll give you an example of what I'm talking about. So another nice feature of the Bloomberg tool is you type in MA and it's got a mergers and acquisition database. And this is 32,000 deals around the world that have been recently announced or completed. So these are ones that happen to be done today. See any US companies did any acquisitions today. But who's been buying somebody recently? Who's a US company that bought somebody? Oh, but this way, I'm going to go a different way. I'm going to make one up. Eli Lilly. Just type in Eli Lilly. Here's a list of all of Lilly's publicly announced deals. So you put a company that's all their deals. So one of their more recent deals for $2.3 billion was to buy a company called Morphic Holdings, right? For $2.3 billion. So if I click on Morphic Holdings, there's a lot of information about the deal. Down here, there's something called deal comps, right? And what this represents is Bloomberg will try and find M&As that are similar to companies that have bought a company like Morphic, right? Probably a small biotech or other early stage startup, right? Now, we don't have a lot of data on these companies, but these were the acquisitions. They go back to 2014, by the way. So not a huge amount of trading in this type of an industry, but nonetheless, these were all the purchase prices paid. And this was, if the companies had profits, 3 of them did, this would be the price paid to EBITDA, it's multiple, price paid to EBIT as a multiple, price paid to revenue, if they had revenue as a multiple. And so these are the industry averages. So for these early stage companies, people paid 60 times revenue. For these early stage companies, they paid about, well, 33 times EBIT, and 2, they paid 548 times EBITDA, which is another way of saying for early stage companies that don't have profit, you tend to value them based on revenue with the assumption they'll eventually make a profit and generate cash flow. But that's the idea of an analysis. So it's just saying that if I go in and offer Morphic Holdings, 20 times projected revenue, then that's pretty low compared to some of the prices we've paid in this industry on average. There's a couple that are in that lower range, but that's the idea of it's called a precedent transaction. So we can use it for M&A. The same thing, we can use it for private companies. I'm going to do an IPO. What am I worth? If I go public, what are similar companies with these profiles worth? What did they go public for? I can use that as a proxy. Precedent transactions. I'll pause. Does that make sense?
Yeah, just real quick, you kind of talked about it's easier for us to depend on lawyers. Let's say you had an IPO recently, why would lawyers be coming after you? they're saying the bank overvalued the company and tried to like, or what?
Yeah, so let's say you did an IPO, I'll make up a number at 10, and then suddenly 30 days later, the company's trading at 5. People will start, the sharks are going to start swimming, and they're going to say, was everything fully disclosed about the company, especially if some new information comes out that looks bad. So I'm just telling you, there's a whole industry of lawyers out there that are looking for reasons to sue companies whenever things may or may not work out according to plan. Right. That's why companies are very careful with their public statements. And that's also why, for example, if you do an IPO, you got to list every risk out there in your prospectus. Because if you don't, and that pops out of the closet, someone's coming after you for that. Because it's a high stakes game if you put in a bunch of money and you quickly lose it. That's why it'll be interesting to me to see how DJT plays out over time. Just because, I know they're disclosing this, but when you got a company that has 5 million of revenue, loses 200 million a quarter, has declining amounts of users, and is worth, I don't even know what the value of the company is today, $3-4 billion. Like, I don't know where you get that value from. It's like a meme stock. Right? and at some point, if a bunch of people lose a bunch of money because it reverts back to its cash flow value, then I think you're going to see a bunch of litigation over that.
Okay, so it's never on the investors for doing due diligence kind of thing. Because I mean, GameStop's been I think a pretty terrible stock for a while, but if it suddenly dropped, pretty low, do you think the same thing would happen?
Well, what I'm saying is, if in due diligence as an example, this can happen in M&As. Like, companies will say it wasn't put into the due diligence. You had risks. We bought you and we found out things that you didn't disclose. That leads to litigation. And that should have adjusted the price that we pay. Now, some of it, legit, some of it's not. But, and sometimes you find out things after the fact. Not everybody sues. But regardless, I'm just saying that you got to be wary out there.
Okay, no, that makes sense.
All right, so back to our slide deck. Where'd it go? Is it sharing? Share, please. All right. So again, probably precedent transactions we're starting to get into. Lack of information availability. Timing might matter. If you bought something in a recession versus a boom market, might have different prices. Finding comparables is an issue. And synergies could play a role. All right, for purposes of this class, I'm going to simplify to 3 multiples. All right, not even 4. We're just going to do 3, given the shortened nature of the class. All right, we're going to focus on price to earnings, PE. We're going to focus on enterprise value to sales or revenue, and we're going to focus on enterprise value to EBIT. Those are the 3 ratios and multiples that we're going to focus on and understanding. All right, so let's start out with a multiple. Multiples are based on key value drivers. If you remember our key value driver equation, we did it for continuing value in our DCF. We did it in week 1 for the class, and we've been using it all semester, that key value driver equation. So here's the way this table works. What I've done in this table is I've taken the key value driver equation. I started with 100 of NOPAT and a 10% WACC, right? And then I plugged in these ROICs from 6 to 16%, and these Gs from 1 to 5%, and these are the results. Okay, so if you had 100 NOPAT, 10% WACC, 10% ROIC, and 1% growth, that's the 1,000. That's the $1 billion. So 100 million NOPAT, the company would be worth $1 billion. That's the result of the key value driver equation. Question for everybody: why in this column right here. Why, as the G's go from 1 to 5%, does the value stay at 1,000, at basically a billion? Why is the value not changing as the growth changes for that column?
Your spread is 0.
Exactly. And if I go to the left of that, 6 and 8%, why is the value going down as the G's increase? So look at 6% ROIC, 1% growth, then 2, then 3, then 4, then 5. So over here.
Is it because your ROIC is less than your cost of capital?
And when you grow it, you destroy value at a faster rate. So this table is just illustrating what we kind of already know intuitively and from previous assignments. Same thing. When you go to the right of 10% and you have a positive spread, ROIC against WACC, then the faster you grow, the more valuable you become. Okay. And that's just the math played out with the key value driver equation. Are we going to clear where these numbers are coming from? All right, let's go to the next slide. All right, so here's how multiples are created. If I take the table that we built on the last slide, put it in the top of this slide, okay? And then what I'm going to do is right here. This is the table from the previous slide. What I'm going to do is I'm going to say, okay, if we had 100 NOPAT at a 35% tax rate, that's 154 of EBIT. So 154 of EBIT at 35% is 100 of NOPAT. So if I know my NOPAT and tax rate, I'm going to work backwards to an EBIT. Okay. So here's how an enterprise value to EBIT multiple would work. If I took 1,000 right here, billion, divided by 154 million, that would be a 6.5 multiple of EBIT. Okay. So basically a zero spread is 6.5 times EBIT in this industry. Okay. If I took 833, 6% ROIC, 2% growth, okay, 833 divided by 154, that would be 5.4 times EBIT. So that's essentially how multiples created. You just take the value of the company, you divide by the basically the denominator, EBIT, EBITDA, earnings per share, revenue, and then basically that gets you a multiple. So here's my question to the group. Based on this data, if there was a company that was trading at 6 times EBIT, what would that tell you? If we had a company trading at 6 times EBIT, what would that tell you?
It would take the earnings, or it would take the company 6 years to earn back what they're worth today.
Okay. And 7 times EBIT, it would take them 7 years to earn back. That's one thing it would tell you. But what else would it tell you? In the context of the key value drivers, what else would a 6 times EBIT tell you?
That growth is 1% with ROIC at 6%.
Is that the only possible answer
Just
for
that
6
their,
times EBIT?
just that their WACC is more than their ROIC.
Okay. So 2 things. One, the second point that was just made about WACC and ROIC, I want to come back to. But I just want to start out with the 6 first. Where are 6s in this table? Is this where my cursor is? Is that the only place that there's a 6?
Correct.
No.
Oh, I mean,
Could there
six
be a
in general.
6?
Oh, okay.
Somewhere in here could be a 6. Okay. So the point about multiples, and this is a really key point I want to illustrate for everybody, is a 6 multiple can have a range of answers. They could be 1% growth at 6% ROIC, 2% growth at like 7.9% ROIC, like somewhere in that range of G's and ROICs is where you're likely to get a 6. But in all cases, it would suggest a negative spread. So somebody trading at 6 times ROIC would likely have a negative spread in this industry. Low growth at negative spread. Because any company with a positive spread would be to the right of this. Any company with a negative spread would be left of this. And a lower than average multiple suggests that it's not expected to have the same spread as the average for the industry. The same would be true if I told you there's a company that's trading at 7 times EBIT. Where are the sevens? 7, 7, somewhere in here, 7. So any of these permutations can get you to 7 times EBIT. So that's the point. All of those permutations suggest low growth, 1 to 3% at a positive spread. So this is what I mean by kind of the oversimplification. So multiples don't give you an exact answer because technically when you work backwards, you can get with the key value drivers a couple of answers, a couple of different sets of numbers that give you the same answer. But so it's really more about the range. But what the ranges tell you is 7 times EBIT, that company likely has a positive spread compared to the others in the industry. 5 times EBIT, 6 times EBIT, that company probably has a negative spread relative to the industry average 6.5. That brings up another important point where you're digesting all this. A naive comment that a lot of people will make on CNBC is they'll say, buy this company because their multiple is below average. They're cheap. They're on sale, right? And the implication is if you buy them in a low multiple, that they should eventually go to the average, right? No. The way they go to the average, if you're trading at 6 times EBIT, the way you go to 6.5 times EBIT, the way you go to the average is you got to improve your ROIC or you got to improve your growth. If you don't improve your growth or your ROIC, you're not going to the average. So there's a reason why companies traded at, it's called a discount, trade below the average of their peers, right? And the reason they're trading at a discount is because multiples are just an expression of future growth and future spread. That's all they are. Multiples are future growth, future ROIC, and future WACC. That's a multiple. That's all it is. That's what the key value driver equation tells us. So an average multiple is average growth, average spread. A below average multiple, discount is what we call it. That's below average growth spread combination. A premium, you're trading above the industry average. That is a growth spread combination that's higher than the industry average. And the industry average is the average growth spread. That's multiples. And that's very important to understand when we're about to analyze these things. I'm going to pause because I threw a lot at you. Questions?
Okay, going back to when you were talking about CNBC, because I've heard that before. That's why I'm like kind of like, oh wow. So by saying that though, are you saying that it's a buy? Like if Kramer would say that, say it's a buy based off of, I'm gonna say like Boeing or something like that. It usually is always pertaining to, or no, sometimes it's always pertaining to like something happening or some type of event just happened. So is that commonplace to kind of say something like that and like adding it, or are you just saying that because or is that being said because you really don't know whether or which way it's going to go, but you want people to buy into the stock? That makes sense.
So when we look at Boeing, and I'll just start out with spread as an example. Hopefully you're seeing my Bloomberg screen.
Mhm.
Bloomberg. If I just pop up their spread, what you're going to see is right now Boeing's performance, for lack of a better word, sucks. Right? They're destroying value. They got a negative spread. They're losing money. They're having all sorts of problems. Right now, Boeing fired their CEO essentially and hired a new CEO with the whole goal to fix the business, fix the operations finally, put the quality issues behind them, put the manufacturing issues behind them, get back to the growth track. Okay. So right now they have a negative spread. But if you actually look at their future, what the analysts are saying, on a 5-point scale, right, there are 4.06 out of 5 because 20 analysts put buys on them. Why are they putting buys on them? You're not going to put a buy on Boeing if you do a DCF with a negative spread. You're not going to get an increase in your share price, right? So the analysts think that the share price is going to go up. You can see them here, 270, 208, 207, 215, 232, 218. Their share price today is 165.
Mhm.
So you did an as-is on this. If we did an as-is on Boeing, what you'd have to do is you'd have to have higher cash flows to get to a DCF of a higher price. It's the only way, right? So here's the point. In order for Boeing to have higher share price and higher cash flows, they got to improve. So essentially, I might pay a multiple for Boeing that's higher, or at least say, look, they're trading at a discount to their peers, but they're a bargain because I think they're going to improve. But the whole point behind that is their ROIC will get better, because their ROIC doesn't get better. You don't get to these share prices.
Gotcha.
So they're trading at a discount because they're effed up now, but the market thinks they're going to get their act together. And you can see that in the forecast for the earnings, which are the basis for the DCF, that Boeing's revenue, this is today, last year, 78 billion, by 2027 is expected to grow to 112 billion.
That's crazy.
Boeing's EBITDA, 1 billion, expected to grow to 13 billion. Net negative income, 2 billion gap to 8 billion income. So the point is, there's an expectation that they're going to improve. So if you're buying Boeing now because they're cheap, then the reason they're going to improve is that their growth ROIC is going to be better. And that's why you might want to buy them. But let's say we had another company that had really poor performance and is not expected to change. They're just a basket case. They're the company's just continuing to do poorly. Well, then they're probably going to stay at a discount. Just like you'd probably call them a sell in the DCF model. Same concept. Does that make sense?
It does. Thank you.
Sure. So what I'm just telling you is, if a company's trading at a lower multiple than everybody else, there's probably a reason for it. Okay. And you're going to trade a higher multiple. That means you got to get to a higher level of growth return combination to achieve that multiple. Okay. So you don't just go there. You don't see two companies with different growth return combinations trade the same value. You wouldn't have the same DCF. You shouldn't have the same multiple. Good question. These are important questions. I want to make sure everybody can connect the dots, because we're about to do some analysis on there that make sure that you have to understand these core concepts. All right. That's the key value driver equation on the right-hand side of the screen. The difference here is when you do price to earnings multiples, PEs, right? Price to earnings is based on earnings per share, which is net income. It's not NOPAT free cash flow, right? And price per share is literally that. It's the equity value of the shares. So what you can do is you can use the exact same key value driver equation. You can plug in equity values and you can actually solve for a PE. So NOPAT becomes net income. ROIC in the equation is replaced by return on equity in the equation. Growth in the equation is growth in net income, long-term growth in net income, not growth in sales or cash flow. And cost of equity replaces the WACC. So using the exact same key value driver equation, you can estimate an equity value of the firm as opposed to an operating value of the firm. Okay. So how does this play out? Using this equation, key value drivers with equity put in. Same concept as tables. So on this slide, we have key value driver equation results. We're going to start with 100 million in net income and a 10% cost of equity. Okay. At these return on equities and these G's, these are the results. So 100 million in net income, 10% cost of equity, 10% ROE, negative spread, any level of G, company's worth $1 billion. What is the price to earnings multiple? 1 billion divided by 100 million, PE of 10. Same concept. Companies trading at a PE of 8. Well, where are my 8s? Well, they're over in this range. 8 somewhere in here, 8 somewhere in here. I know that's a negative spread. Where are my 12s? Well, 12s would suggest probably somewhere here to here. That's in the positive spread territory. As we said, companies at 8 don't just arbitrarily go trade at companies at 12. You could say this is a discount to that company, but the only way that they're going to trade at 12 if they're trading at 8 is they got to improve their ROE. If they improve their ROE, they'll trade at 12. That's Boeing. So the idea for Boeing is Boeing's over here right now, right? And the market's saying, we think that they're going to get over here. That's why you should buy them. They're undervalued. But they got to go do it. If they don't do it, then they're going to go, they keep earning down here, they're going to be worth down here. But that's the same idea of the multiples. Does that kind of make sense? Questions? All right. So again, as a reminder, even though we will do PE, we still prefer enterprise value for reasons I told you earlier, is that essentially the problem with PE is it's based on net income. And so there's a lot of things that could distort net income, and it just makes the PEs a little bit less comparable, right? Where enterprise value, EBIT, EBITDA tends to be less distorted because they're EBIT and EBITDA less impacted by accounting adjustments and less impacted by things below EBIT. So therefore, they tend to be more normalized. Now, here's the thing. Let's say you want to do EV to EBIT. How do you do an EV to EBIT multiple? This is what's interesting. It's just the key value driver rearranged. This is the key value driver equation. I want to get to EV to EBIT. How do I do that? Well, take our NOPAT times 1 minus G over ROIC divided by WACC minus G. Well, NOPAT is EBIT after tax. EBIT times 1 minus the tax rate. If I divide both sides by EBIT, enterprise value to EBIT, that EBIT cancels out. I'm left with 1 minus the tax rate times 1 minus the G over ROIC over WACC minus G. This formula, which is the rearranged key value drivers, so it's still key value drivers, directly allows you to calculate an enterprise value to EBIT multiple. Those are the drivers. And so what's different about the EV to EBIT direct formula than the traditional key value drivers is you break out the impact of taxes. So what are the drivers of enterprise value to EBIT? Tax rate, growth, ROIC, WACC. What were the drivers of your bull, your bear, and your target? Tax rate, growth, ROIC, WACC in the DCF. Those drive enterprise value to EBIT. Those drive enterprise value multiples and DCFs. Enterprise value to revenue multiple. I can actually get from the key value driver formula to an enterprise value to revenue multiple. Rearrange math. NOPAT is revenue times margin, after tax margin. So revenue times EBIT after tax divided by revenue. If I take both sides divided by revenue, the revenues cancel out, and I'm left with my margin times the 1 minus the tax rate, 1 minus G over ROIC, WACC minus G. Basically all that stuff. So that's the direct formula for enterprise value to revenue. Right here. Here's what's interesting. All of this from here, right there, is that formula. So if that is the formula for enterprise value to EBIT, then enterprise value to revenue equals the EBIT margin right there times the enterprise value to EBIT multiple. If we take the enterprise value to revenue multiple and we divide by the enterprise value to EBIT multiple, we get the EBIT margin. We've been doing that for 2 weeks. That's what we did in our DCF. If you remember in the assumptions tab, where I had you take the enterprise value to revenue and divide by the enterprise value to EBIT, I knew mathematically that had to get you this number, the EBIT margin. This divided by that is that. Because all multiples are based on the key value driver equation, and it's just rearranged math. That's all they are. And so therefore, multiples are an expression of growth and spread. Threw a lot at you. We're about to take a break, but before we do, because on the other side of the break, we're going to start analyzing real data and trying to explain why companies are trading at higher or lower multiples, premiums or discounts versus others. But this was the math behind it that was also in the book. Questions before we take a break? All right, so we're gonna take a break, 15 minutes. We'll say let's come back at quarter after. So actually give you 17 minutes. I'm gonna stop the recording and then we're gonna do some analysis on the other side. All right, recording is back on. Welcome back, hopefully from the break. So what I want to do next is start the process of analyzing the multiples. And again, this is going to be the core for your assignments and your group projects. So I'm going to start with this. So here are some multiples for, we're going to start with the airlines from a few weeks ago. This is the PE multiples for Southwest, Delta, and American. Okay. And so this is actually based on real world data at the time. All right. And we'll talk next after we kind of analyze these multiples about where the data comes from and how to put this together. But the idea is these are the four elements of the key value driver equation. Okay. Expected profit, growth, return on equity, not ROIC, and cost of equity. These are the results of the key value driver equation. And so instead of the value is the enterprise value, the operating value, this is going to be the equity value. And so the way the PE works, if you take the equity value divided by the income, you get a PE. Okay. Now, this is the FY2 PE from the EEO screen. So basically next year's price to earnings multiple. Okay. And just as a reminder, back to Bloomberg, let's take, I don't know, use Boeing as an example because I'm here, EEO. So for example, this is forward year 2, okay, for Boeing right now, 1, 2, right? If I took Boeing's current share price, which today they closed at, where'd it go? Load the screen. 165.04. If I took 165.04, which is the current share price of Boeing, and I divide it by next year's earnings, 4.443, that would be a price to earnings multiple of 37. If I take the 165 price divided by third forward year, 8083, that would be a 20.42 PE. Okay. So these multiples that you've already been using, it's basically the value of the company today divided by the forward numbers. That's how you get the multiples. Okay. So again, we'll come back to that. But for our purposes, calculated results, these were second forward year PEs for Southwest, Delta, and American. Okay. So here's the analysis that we're going to do. Okay. And so the idea is using the key value driver equation, just like an as is, we match mathematically the multiple that we see in the real world. So Southwest PE was 10.7 times next year's earnings. Delta was trading at 5.85 times next year's earnings. American was trading at 3.39 times next year's earnings. In fact, it's the sad state of American Airlines that, as somebody said earlier, you can buy all of American for about 3 years worth of net income. That's all they're worth. The next 3 years, that's it. All right. So what we're going to try and do is explain the differences in the PEs. Okay. Now, if a PE is trading higher than another, Southwest higher than Delta, that's called a premium. Southwest PE is trading at a premium to Delta. If a PE is trading lower than somebody else's, that's called a discount. Delta is trading at a discount to Southwest. Okay. So the analysis we're going to do is we're going to compare this company, column B, against two peers. So Southwest against Delta. Why is Southwest trading at a premium, 10.72, to Delta's 5.85? These are the four factors, right? But what we really realize is there's three, because if we do key value drivers, we realize that the net income doesn't matter, doesn't affect PE. Remember that from the first week of class. So what really explains the multiples are the growth and the spread. So here's the growth and spreads for these two airlines. First thing we notice is Southwest has a positive spread, 11% ROE against a 9.7% cost of equity. Delta is a negative spread, 6.9% return equity against a 10.9% cost of equity. Okay, so that's one of the reasons why Southwest is trading at a higher PE. Second, Southwest is growing their positive spread, 2.3% growth, positive spread. That gets you a high PE. Then this 4% growth rate of a negative spread is leading to the lower PE. So why is Delta trading at a discount to Southwest? Because even though Delta has higher growth, 4% versus 2%, Delta is growing a negative spread, 7% ROE against 11% cost of equity rounding off. Southwest is growing half the rate of Delta, 2%, but they're growing a slightly positive spread, 11% ROE against about a 10% cost of equity. That's why Southwest is trading at a premium. There's a third reason, and this one is often overlooked. Southwest is also trading at a premium because they have lower risk. Their cost of equity is absolutely lower than Delta's. If I have a lower cost of capital, my discounted cash flows are worth more. So the third reason is Southwest is trading at a premium is because of their lower cost of equity. Because if they trade at the same cost of equity, Southwest PE would be 9. But because Southwest has a lower cost of equity, Southwest PE is 10.72. So there's three reasons why Southwest is trading at a premium to Delta. I'm going to pause. Everybody follow that? All right. Why is American trading at a discount to Southwest? Well, similar reasons. Southwest has a positive spread of about 1.4 points, 11% return equity against 9.7 cost of equity. America has a negative spread, about negative 5 points, 6% ROE against 11% cost of equity. American is also growing that negative spread more than twice as fast. They're expected to grow that negative spread at about 4.77% a year. Southwest is growing their positive spread at about 2% a year. Not growing as fast, but they're growing fast with a negative spread. That's hurting the PE. And American has the highest cost of equity. That is further reducing their PE. So all three things, they're growing the negative spread. In fact, they have a negative spread and they have the highest risk, are why American is trading at a discount to Southwest. Questions? That's the analysis you're going to have to do for PE. Let's look at PE in another industry. Here is pharmaceuticals. And I didn't finish this one, so I'm going to hide this. Look at these three companies: Johnson & Johnson, Merck, Lilly. Right? Why is Johnson & Johnson, column B, J&J, trading at a discount to Merck, or sorry, Eli Lilly in column D, Why is Johnson Johnson trading at a premium to Merck in column C? Okay, so let's do Johnson Johnson against Merck. Why is the PE at J&J higher? Right. Well, Johnson Johnson has a lower spread than Merck. 32%, still pretty good ROE against a 7.5% cost of equity. It's very high. But Merck has a 41% ROE against a 7% cost of equity. So Merck has the higher spread, right? But the problem with Merck is they're expected to shrink over time, negative 0.8% growth into perpetuity. Johnson Johnson, 0.1% growth. So they're kind of staying flat. The problem with Merck is they're expected to shrink. So that negative growth, about negative 1% a year, is why Merck is primarily trading at a discount. Even though Merck has a slightly lower risk, 7.1% cost of equity versus 7.5%. But even if they have the same risk, Merck would still be trading at a discount to J&J because of the negative growth rate. Why is Eli Lilly trading at a premium to J&J? Well, number one, Eli Lilly is expected to have the biggest expected spread in the future, about 60 points, 68% ROE against an 8% cost of equity. They're also expected to grow that spread at the highest rate of the three companies at 5.8% a year. So it's high growth, high spread. That's why they're trading at a PE of 40. And that's what you would expect, right? And oh, by the way, they have the slightly highest risk. So that's kind of dampening this. If Lilly had the same cost of equity as J&J, their PE would actually be 55. So they got a little bit of a headwind on risk, but what's compensating for that is the high growth, high spread. And that's why Lilly is trading at a premium to J&J. J&J is trading at a discount to Lilly. Questions? And by the way, what's behind this? Why does Lilly have such a high growth rate and a high expected return? Does anybody know? In the real world, what's behind that?
The fact that they have Ozempic, which is like the current high drug that's popular, but they also have a Alzheimer's drug coming down the pike that will help as well. And they're trying to get a pill for weight loss as well, because Norvasc or Nordisk is coming up with their own pill for weight loss.
Close. So you had it all right, except Ozempic is Novo Nordisk. Lilly's version of Ozempic is called Mounjaro.
Mounjaro, yeah.
But the whole point is exactly, you had the right idea. It's that booming weight loss. Lilly's taking advantage of that. J&J doesn't have that. Anybody know why Merck has a negative growth rate? We actually talked about in the first day of class. You can reach deep into your memories.
Their patent expired.
They have a drug called Keytruda, which is booming, which patents expect to expire in 2028. And they're going to start losing the patent protection, and they don't have anything to replace it on that scale. So that's why they have a negative G. Negative G doesn't always mean you're going away. A negative G could mean that the future is just a little bit worse than the present. Industry number 3, tech firms. Meta, Microsoft, Alphabet / Google. Why is Meta trading at a discount to Microsoft? Meta's trading at a discount to Microsoft. These are both very high growth companies, 7.2% G against 7.6% G. Microsoft's got a higher growth rate. Meta actually has a slightly lower spread. 30% versus 11, it's about 19 points. 33 versus 10. So Microsoft is trading at a premium to Meta because they got a slightly higher spread, a couple extra points, and they're growing at about 0.44% more per year. And Microsoft has slightly less risk, 10.2% cost of equity against 10.8. That's why Microsoft is trading at a premium to Meta. That's why Meta is trading at a discount to Microsoft. For Alphabet / Google, this is before the antitrust litigation, the guilty verdict yesterday. Alphabet has the lowest growth of the three, 6.5%. Now they have the lowest spread of the three, 28 versus 10 is about 18 points. So they got the lowest spread, they got slightly lower growth, and that's why they're trading at a discount, 20 versus 21. That's not that far of a discount, even though Alphabet also has slightly lower risk than Meta. But what they really lack is a little bit less growth and a little bit less spread. That's why Alphabet is trading at a discount. But here's what I want you to understand at a macro level. Do you see these PEs? They're the low 20s. And do you see these PEs, which are single digits to 10? There's a reason for that. There's a reason why the airline industry is trading at these low multiples, because they have terrible spreads. There's a reason why these tech companies are trading at high multiples, because they have great spreads at high growth. We know that from key value drivers. That's what we're seeing played out. That's what we're explaining using the key value driver equation. Here's the PE for Verizon, AT&T, and Comcast. Chris?
I don't know if you covered it, but does the capital structure play a big role in the PE?
Well, capital structure will affect cost of equity.
Right.
So it does. And capital structure affects net income because interest is part of net income. So capital structure, as it talks about in the book, does distort the PE. High levels of debt can actually make the PEs look higher.
Okay.
Take your operating profit, subtract the interest expense, you get lower net income. And so as you lever up, your PEs can look a little bit more distorted and higher than they otherwise should be. Time to practice. Somebody explain to me why AT&T is trading at a discount to Verizon. Try and make these numbers a little bigger. Why is AT&T trading at a discount to Verizon? Let's take a shot at that. All right, Raymond.
AT&T one has a higher risk because the cost of equity is higher than Verizon.
Okay, the 8.2 versus the 7.7.
It has a lower growth rate than Verizon.
1.5 versus 2. Got to use numbers.
I'm sorry. Okay, and I believe no. Not sure. I think that's it.
So why is AT&T's spread, or sorry, why is AT&T's multiple lower than Verizon's? Why is AT&T at a discount? What connect the dots there, Lucas?
Verizon's spread is less worse than AT&T's. So it's a better spread.
That's one of the reasons.
Oh, I would say, I guess Verizon it's growing its spread at a higher rate.
But if you grow a
than
negative
AT&T.
spread at a higher rate, that makes it worse.
Oh, right.
Why? There's a third reason. What's the third reason? Growth, spread, and reason number 3.
The cost of equity is a little bit higher.
For who?
For AT&T, about 5%.
Yeah. The extra 0.5% of cost of equity is lowering the PE. We can do math. So if AT&T had the same cost of equity as Verizon, their PE would be 8.13, not 7.52. Okay. But it's not. It's higher. Therefore, the PE is even lower. So one of the other reasons Verizon is trading at a premium is because they have a lower cost of equity. So just remember these 3 reasons when you explain. Give you one more. Here is a company, Siemens Energy, Schneider Electric, Vestas, which is a renewable energy company in Europe. Somebody help me explain these PEs. Why is Siemens Energy trading at a discount to Schneider Electric? 15 versus 23. Theodore?
Okay, so Schneider has a higher spread. Does it look like 8 versus 3?
Okay.
And it comes with a slightly higher risk or cost of equity, but they're also growing the net income at a higher rate with the higher spread. So Schneider gets the premium.
Yeah, they get the higher growth of 7% versus 5 with the higher spread. Higher growth, higher spread, higher PE. But you mentioned cost of equity. The 9.5 at Schneider versus Siemens. Is that helping or hurting Schneider's PE?
It's hurting them, slightly higher risk than Siemens.
Yeah, so two things are helping Schneider be higher. One's actually mitigating that. So just make sure you understand that the cost of equity is hurting it. Because if Schneider had a 9% cost of equity, key value driver formula tells us that their PE would be 29. So there's a little headwind for Schneider, but they're still doing much better because the higher growth, higher spread expectation. Why is Vestas trading at a premium to Siemens?
Both the cost of equity is lower, so therefore Vestas has a lower risk, but also the spread is much larger than Siemens. You're looking at what is that, 14? No, 16. Sorry, 16 versus a 3. So for those reasons, the one thing that does hurt Vestas is the fact that their growth rate is lower for net income, the 3.6 versus the 5.32.
Right, Logan, you're generally right. Although I'll tell you, if this were your homework assignment, if this were 4 points, I'd give you a 2 because you didn't use any numbers.
Okay,
got to use numbers. That's for everybody's benefit. So you had it exactly right with what you were saying. Please continue to use the numbers, because if you go back and watch this video, it's being recorded. And what I'm saying is, when you're listening to him, you might have trouble following along if you're not as familiar with what he's looking at. If he uses numbers, it's easier to follow along. It's like putting the cursor on there. So please use numbers. But yes, that's why Vestas is trading slight premium. They have a much better spread, but they just lack the growth of the higher spread. And they also have a slightly lower risk. Questions about PE analysis? All right, we're going to go to multiple number 2. Multiple number 2 is the enterprise value multiple, EV to EBIT. Okay. Down here is the EV to EBIT formula. Down here is the EV to EBIT from the EEO screen, second forward year. Okay. So matching, these are the 4 inputs into the EV to EBIT equation that was derived in the book and in the PowerPoint slides, the rearranged key value drivers. So you plug in those 4 numbers, you get that value. So when we do EV to EBIT, we are doing the WACC, not the cost of equity. We're doing the ROIC, not the ROE. We are doing the tax rate, expected tax rate, similar to the DCF tax rate. This is the long-term ROIC, and this is the long-term growth rate, not the one-year growth rate. Okay. So why on an enterprise value basis is Southwest trading at a premium to Delta? Well, let's look. Number 1, tax rate. Southwest is paying higher taxes than Delta, 23.5% versus 17.8%. That should hurt Southwest enterprise value to EBIT multiple. Okay, so that's kind of working against them. That's not why they're trading at a premium. Number 2, 4.7% growth rate, 5%, 4.79% growth rate. On an operating basis, right? This is growth in EBIT now, not growth in net income. Delta is growing slightly more, 4.79 versus 4.7, but these are pretty close to each other, right? So why is Southwest trading at a premium? Southwest spread is negative on an operating basis, 7% operating ROIC versus 8% WACC, 7% versus 8.5%. A little bit better with Southwest, but still negative. So they're basically growing a similar rate, similar negative spreads. Why is Southwest on an operating basis trading a slight premium? Because Southwest is perceived to have a lower WAC, the 0.5% WAC. So it's really that 0.5% lower WAC and slightly less negative spread is why Southwest is trading at a premium to Delta. Interestingly, American, which on a PE basis was only worth 3 times net income, is worth 8 times EBIT. Okay. Why? And the answer is they have the lowest growth of the three, 4.27% versus 4.79 and 4.7. They also have a negative spread, 5.8 against 6.7, but they are basically slightly less growth of this negative spread is helping American. And the other thing is American has the lowest WAC of the three, right? Because American has a lot of debt in their capital structure. And the other thing that's working against America is the highest tax rate, 25.3% versus 23.5% at Southwest. So why is American kind of at parity with Southwest? Short version is they're destroying value at a slightly less rate, 4.3% versus 4.7%. And that's why, despite the fact that they have a worse spread and a higher taxes, they actually trade at a slight premium to Southwest. That and the lower risk. Why is Delta trading at a discount to Southwest? Again, similar growth. Delta has a lower tax rate, 17.8%. That should be helping the EV to EBIT. So basically, they also have a little bit more of a negative spread, 6.92 versus 8.5. So the real reason, it's the 8.5. The driver for Delta's lower multiple is the WAC of 8.5% versus Southwest of 8. That's why they're really trading at a discount. Those are the operating multiples. Let's jump over here to pharma. These are the EV to EBITs for, and again, I didn't finish this one, so I'm going to hide this. J&J, Merck, Lilly, right? As opposed to PEs. So why is J&J trading at a slight premium to Merck, 12.16 versus 11.8? Well, number one, J&J is expected in the future to have a pretty high spread, 41.8% against 7% WAC, Merck 1% against the 6.5% WAC. The reason why this negative spread is not hurting Merck a lot is because they lack any growth on an operating basis. So if you just kind of maintain that spread, you don't grow, it doesn't get worse. It doesn't get better. So for a slightly lower tax rate, the real reason that they're competitive is because of this lower cost of capital. If Merck's cost of capital was 7.3, they'd be trading at more of a discount. Why is Lilly, Chris?
Once you finish this, I had a question on the airlines.
Okay,
Sorry.
why is Lilly trading at a premium? Similar reasons. It's all about the growth. This is Manjaro, 6% long-term growth. Lowest tax rate, 14. And highest spread, second highest spread, 25% ROIC against a 8% WAC. But this high growth, high spread is why they're trading at a premium. 37 times EBIT versus 12 times EBIT. That one's pretty easy. Very similar to the PE. All right, back to the airlines.
Yeah, the tax rate here, is that driven by domestic versus international travel?
Yes.
Okay.
It gets back to the guidance, and depending on where you're earning your revenue, what jurisdictions, and what tax rate you pay in those jurisdictions will impact the tax rate. So if you have more domestic, you're going to have a higher tax rate than probably other airlines.
Okay.
Good observation. Tech. Somebody tell me about Meta and Microsoft. EV to EBIT. Why is Meta at a discount to Microsoft? Lucas?
So Microsoft has a higher growth of 7.19 compared to the 6.6 from Meta. Microsoft also has a higher spread, about 35% versus the 21% or so from Meta. So it's growing at a faster rate with a better spread. And lastly, Microsoft has a lower cost of capital, so it's less risky.
Actually, there's one more factor here. There's a fourth factor when you do this. Tax rate.
Oh, yes. Microsoft's tax rate hurts them, but the other factors outweigh the slightly higher tax rate.
Yeah, matter of fact, when you guys get this model, you could put in the 17% tax rate. At that equal tax rates, it wouldn't really change the multiple that much. Okay, so it's a little bit of a hurt, but the real reason Microsoft is doing better, as you said, high growth, high spread relative to Meta. Why is Alphabet trading about the same slight discount as Meta? What makes them similar? Although I would call it slight discount for Alphabet. Meta against Alphabet.
I was gonna say Meta or sorry, Alphabet has a less, by about percent less growth rate, which hurts them. But their tax rate is up above about 4%, which is pretty nice. And they also have a bigger spread of about 23% spread to a 21% spread. So the spreads are close to each other, but they're growing at a slower rate, even though they're paying less taxes.
Yep.
So all things considered, they're pretty darn close to each other. It's just that they have slight differences in them, and Google is paying less taxes, which is helping them compete with their lower
Remember
growth.
when I showed you that table before the break and I said permutations? This is an example of permutations. Alphabet basically has slightly lower growth but slightly higher spread. Meta has slightly lower growth at slightly higher spread. Meta has slightly higher growth at slightly lower spread. They kind of end up pretty close to the same point at the same level of risk. 10-3, 10-5 whack, pretty simple. So you can kind of get to the same multiple with slightly different growth ROIC combinations, and Meta and Alphabet are fairly similar in that way, but they get there slightly differently. Nuances. All right, Verizon. Tell me why Verizon is trading at a discount to AT&T, EV to EBIT.
So Verizon has a negative spread of roughly 2% versus a negative spread for AT&T of roughly 1.5%. And then if you pair that with the fact that Verizon's estimated growth is 1.5%, meaning they're destroying value more quickly versus AT&T's 1%. So you have a negative spread getting worse more quickly than you do a negative spread getting worse, but more slowly. They pay about the same taxes, so that shouldn't have, and they pay exactly the same tax rate, actually at 23.5%. So that shouldn't impact the ratio. So it's coming down to the more negative spread and faster value destruction for Verizon.
You're 90% of the way there. There's a fourth factor.
Is it the whack?
Yeah, good call, Sarah.
So say something more about the whack.
Sorry, me.
Either. Sarah, why don't you jump in?
Okay. The whack for AT&T is at 6.4. And Verizon's is at 6. So the higher the whack, it essentially just hurting AT&T.
Yeah. So that's not why AT&T is trading at a premium. It's what you said earlier. It's the lower growth at the less, they're destroying value at a lower rate.
Yeah.
Is really why AT&T, but they're both destroying value.
Yep.
Right. So Sarah, since you did a great job jumping in, you want to do Verizon against Comcast?
I will attempt. I will do my best.
Hey, that's all right. Jump in and help you.
Okay, so I guess the first thing, Comcast has a higher tax rate, so that's gonna 27, while Verizon has 23.5, so that's going to favor Verizon in terms of I guess their value. And then in terms of the spread, Comcast has a positive spread of 0.2, but they're only growing at 1%, while Verizon has a negative spread of about 2 and is growing that at 1.5%.
Okay.
And then Comcast, I guess, has the higher whack. So I guess after looking at this, though, I would think that Comcast, I don't know why, but I was thinking that Comcast would actually be doing better. But I guess maybe the tax rate hurts them more.
Well, the tax rate of 27 does make a difference.
Mhm.
Let's put this down here to 23.
And because like their spread is essentially almost like 0 and it's growing at 1%.
And so this is something that's very important, key value drivers. If you have a 0 spread, then growth doesn't matter.
Yeah.
So that's the one thing that's, you can argue, is benefiting Comcast, is that they're at least kind of trading close to trading water. AT&T and Verizon are underwater when it comes to their spreads. So that growth hurts them more.
Got it. Okay.
Everybody clear on those? Good job. All right, multiple number 3, EV to revenue. We'll go back to the airlines. So all these multiples, another way of saying it, the simple version, if I drive $1 of EPS, it should mean $10.72% of value, $10.72 of value. Dollar of EPS, $5.85 of value. Dollar of EPS, $3.39 of value. Dollar of EBIT, $8 of enterprise value. Dollar of EBIT, $6.82 of enterprise value. Dollar of EBIT, $8.19 of enterprise value. Okay. The third multiple, EV to revenue. For every time Southwest sells a new $1 of tickets, it adds 46 cents to their enterprise value. Every time Delta sells $1 of tickets, it sells 87 cents to its enterprise value. $1 of revenue at American adds 67 cents to its enterprise value. That's EV to revenue. Okay. Remember, in the formula, EV to revenue divided by EV to EBIT is margin. One of the biggest drivers of EV to revenue is your margin. Okay. So that's the point. Like, the bias is, if I sell things at a higher margin, then the more I sell, the more cash I'll generate. Theoretically, the more I would be valued. Okay. That's just the simpleton's view of EV to revenue. So margin is a big driver of EV to revenue. However, if you remember the formula, EV to revenue divided by EV to EBIT is the margin, then built into that EV to EBIT multiple is ROIC. So it's not just margin, it's also your ROIC. So what I've done here is, based on this expected ROIC and this expected margin, because if we take the EV to revenue divided by EV to EBIT, we know what the margin needs to be, then margin times productivity equals ROIC. So after-tax margin times productivity equals ROIC. So you can actually back into, which is what this model does, if I know the estimated margin for the multiple and the tax rate, and I know the ROIC, I know what that productivity has to be. Invested capital to sales. So why is Southwest at a big discount for when they sell tickets? Number one, relative to Delta, they make 5.7% pre-tax margin when they sell a ticket. Delta makes almost 13% of pre-tax margin when they sell a ticket. That's going to drive a higher EV to revenue. Number two, after tax, 4.3% versus 10.5. Again, Delta making more after tax when they sell a ticket. The one thing that's hurting Delta is to drive $1 of revenue, Delta's spending $1.52. To drive $1 of revenue, Southwest is spending 60 cents. Right? So the one thing that is helping Southwest is the productivity. And you see that in their ROIC, that they actually have a slightly better ROIC than Delta. Okay. So that's why it kind of closes some of this gap in EV to revenue, but Delta's getting higher EV to revenue because of that giant margin. American is between the two, 0.67 versus 0.46. Why are they trading at a premium? 8% margin pre-tax, 5.7% Southwest. They're making more every time they sell a ticket. 6% after tax when they sell a ticket, 4% pre-tax or after tax when Southwest sells a ticket. But American spends more, $1.05 to generate $1 revenue, and Southwest 60 cents to generate $1 revenue. So again, Southwest gets a better return, 7% versus 6% because of that. But American still gets better EV to revenue because of this higher margin. It's being somewhat offset by the worsening productivity. Could be much better if their productivity was higher. Pharma. When J&J sells $1, it adds the $4. $1 of revenue is $4 of enterprise value. Merck, $1 revenue, $5 of enterprise value. Why? Merck has a higher margin, 43% pre-tax versus 33% pre-tax for J&J. After tax, 37% versus 27.5%. Okay. The one thing, and this is just a quirk right now, Merck's productivity is distorted. Just weird data that's coming in. So I don't think that's truly representative of their long-term invested capital. But basically, why is Merck trading at a higher operating margin? It's the EV to revenue. And by the way, every now and then you're just going to get a wacky piece of data. These academic formulas, you're going to get some noise every now and then. You've got to deal with it. So just be aware of that. Right? Why is Lilly trading at the highest EV to revenue? Number one, they don't have the highest margin. Pre-tax margin 38 versus 43, but they're higher in J&J. After-tax margin 33 versus 27.5. You'd expect that to have a higher EV to revenue. Why is it so much higher? They don't have the highest ROIC because their productivity is worse than J&J, 1.32 versus 0.66. But why is this more than double? The other factor, remember driving margin EV to revenue, margin times EV to EBIT, it's the growth. Is that they're growing this high margin at a high rate that makes their sales more valuable. So the other thing driving Lilly is the 6% G. It's helping their EV to revenue as well as the high margin. That one's a little bit more complicated. All right. Meta versus Microsoft. Batter up. Somebody tell me. 6.8 at Meta, 10.7 EV to revenue Microsoft. Why is Microsoft at a premium to Meta for EV to revenue? Lucas?
I'll take a stab at it. So they have a higher operating margin of 43.8%. They also have better productivity as far as the dollars that it takes to drive the sales.
Who's got the better productivity?
Microsoft.
Okay.
So they have 80 cents as opposed to the $1.08 from Meta.
Okay.
They're also growing at a faster rate. Microsoft's got 7.2 versus Meta 6.6. And then I'm forgetting now, does the spread affect that EV over revenue or not really?
Yeah, I mean, to some degree, if the cost of capitals are similar, it won't affect it, but there's a big difference in the cost of capital. That would apply this as well. probably not a big difference here, the 0.5%. So I think, as you just said, all three are kind of favorable to Microsoft, which is why EV to revenue is high. This one's pretty clean. Marcos, I saw your hand up. Why don't you do Meta against Alphabet?
So Meta against Alphabet, if you look at their operating margin, Meta's operating margin is higher than Alphabet's, but looking at their estimated long-term growth, Meta does have a higher percentage in long-term growth than Alphabet, 6.6 to about 5.8. Also, their tax rate is slightly higher, but it probably doesn't affect the long-term actual earnings to revenue ratio as much. Also, their capital, they're working at their WACs are about the same. It's not wouldn't really affect it much, but the spread is slightly higher for Alphabet, but I'm not sure if that affects it either.
Okay. So again, summarizing, even though Alphabet has a slightly lower operating margin, 35 versus 41, and an after-tax margin of 31 versus 34, Alphabet kind of makes up for the lower margin with the better productivity, 0.7 versus 1.08. Okay, so that kind of catches them up closer to 5.83 versus 6.83. But Alphabet also lacks the growth, as you pointed out. Alphabet's growing at 5.76, Meta's growing at 6.6. So the slightly higher growth, the slightly higher margin is why Meta's trading at a higher EV to revenue. Which